here is, these two curves show corporate investment. Fixed investment is the darker line, which is, that's according to HSBC. And advertising is the yellow line, calculated by us. This is in real terms, by the way, which is the way that the economists measure investment. I've put the curve up just to show a couple of things. Firstly, that investment generally is a volatile thing. We often moan that advertising is too discretionary. But I think this is evidence to the contrary, that our clients are in fact more consistent with their advertising investment than they are with their general investment strategies. And it's true that advertising is a more discretionary expenditure. There are two sides to the coin. In September, there was, I suppose it became known here, there was a generalized reduction in advertising spend across the world, which all of our sector leaders have failed to explain, really. But it's proof of anything that advertising is indeed a discretionary thing. Any form of investment is ultimately affected by corporate confidence above anything else. After all, that's what governs whether corporate money stays in the bank or gets spent. The corporate cash pile around the world now is unbelievably huge. In Europe and the USA, about $2 trillion. In Japan, about another $2 trillion. Obviously, as a media agency, client profitability is probably the thing we want to see most of all. But from a macroeconomic perspective, a large share of corporate wealth in the economy means a correspondingly smaller share of wage wealth in the economy, which has an effect on consumer demand. Which returns me again to the latent possibility of recovery starting in the USA, where consumers have made reasonably good strides about paying excess debt down. House prices appear to be recovering, probably one of the strongest stimulants for advertising there is. And US output is already above the pre-crisis level, which of course it isn't in Europe. So I think of this corporate treasure as being like a huge water tower. And if more of it is released into wages, we could see a very strong recovery in the US again. Of course, US wage rates are connected to Chinese wage rates and that sort of thing too, when it all gets a bit macro for this sort of environment. The two curves for the faster growing world tell us two things really. That the industrializing world is probably putting too much, investing too much of its wealth in fixed capital and manufacturing, and insufficient investment in services and consumption. And it also tells us that it's probably under-advertised. So my main conclusion from this chart is that even if there are mid-term constraints on the growth of the BRIC markets, there's a very long-term positive for consumers and advertising too. I see a similar pattern in China and Brazil where wealth is being slowly redistributed from the very rich to the very poor. And so the very poor are being brought into the lower end of the consumer band, which I think is a very strong positive for advertising, particularly TV. The relative contributions, the sources of growth in advertising in our forecast next year. This is just to show you how the old world, which is the industrialized world, growth is very much dependent on digital. And in the newly industrializing world, growth is much more dependent on the growth of traditional media, specifically television. Western Europe in the middle here. We're still using a lot more print in our advertising mix than anywhere else in the world, 34%, versus a global average of about 25%. Nevertheless, we're adding 2.5 billion in digital investment next year, which is a typical increment. I mean, it's been that sort of $2.5 billion level for the last 10 years. Digital share in the newly industrializing world is about 14%, growing about 2 points a year. In the developed world, online is 25%, growing about 2 points a year. This is to show the importance of traditional media in the newly industrializing world. Now, the newly industrializing, faster growing world is providing 70% of the growth we can expect in advertising. And within its traditional media is providing about half the expected global growth. So this is just a kind of reminder that traditional media skills are very much in play in these developing markets, just as they are in the West too, where we have this heavy emphasis on pricing and delivery, which means absolutely keeping the skill set fresh on traditional media as well as innovating in digital. Here are the principal sources of growth in our 2013 forecast. So we're looking at a hoped for 26 billion growth in total global advertising next year. The dependence on this group, which amazingly includes the UK, is 62%, which is a little bit high for comfort. I think we're okay with, as I've mentioned, for reasons I've already told you about the long-term evolution of the consumer economies in the BRIC markets. The UK was a little bit of a surprise to see it here. We were expecting about 3% growth this year and next year. And there's no obvious reason for this that you could relate to consumers or to employment or certainly the growth of the economy or the state of our public finances, all of which are, kind of on life support. So the best reason I can find is that it's because our economy is now so highly digitized. Online investment is now 40% of total advertising investment. And yesterday in the newspapers, Google's boss in the UK and Ireland came up with a figure, I don't know how he calculated it, that 10% of Britain's GDP is online related. I don't know what that means, but it's apparently the highest in the world. And what I do see with our digital sector is that it's continually expanding the spectrum of marketing communication. And it keeps doing it. And now we've got Facebook suddenly making itself more useful to us. And we have this intriguing segmentation of social media in the UK now, which is where it's really helping us focus on what the point of social media is. We're finding different uses for Twitter or Facebook or Pinterest and that sort of thing. So, I mean, that means that it leaves the UK with 3% average growth. That's still only a sort of maintenance level for advertising, really. I mean, it's barely keeping pace with our miserable economic growth. So this is the final chart, which just shows the state of play across the regions. The 2 points here I would want to bring your attention to is that Central and Eastern Europe is adding about twice as much new growth as the entirety of Western Europe, even though it's only a fifth of the size. Russia and Turkey still doing extremely well. The only surprise in Eastern Europe was quite a sudden downgrade from Poland, which is one of the countries I would have had greater hopes for. Poland's about the only country which hasn't had a recession in Europe. But that's explained by a sudden deterioration in the growth rate in Poland, which has had a marked effect on advertiser sentiment. And our agency there tells us that clients are intending to shift investment to Russia and other markets, which may or may not be true. And Asia Pacific is the other one. The deterioration here is entirely to do with this slowdown in Japan, because it's important to understand that Japan is still the third largest advertising market in the world, behind China now. But the tragedy of the tsunami and the recovery has provided very much a one-off spike in growth in 2012. So there it is. It's not. My conclusion is that we have to be conservative about our expectations next year. We have the potential for a pleasant surprise, I think, in the USA. Europe, I'm afraid, will remain a drag on global growth, and I don't really see our way through that. And the principal sources of our growth, the newly industrializing world, I think we can be reasonably confident those forecasts are going to be borne out. 5 years' time might be a different story.